People saw the mailbox cash. There was no really correspondence. To your point, it was very easy. They were getting their checks. And I think it's difficult when you're a 1031 buyer to understand sometimes what are the downsides, because as we've seen in this retail environment, there are some downsides to situations when you're so invested in the actual tenant and its operations, because you can get in situations where finding someone to step into the shoes and buy that lease after the fact, after they've left, it's very difficult.
This episode brought to you by Suites at Madison. Meeting and conference rooms for rent by the hour, week, month, or year. Suites at Madison, where business gets done. Check them out at www.downtowntampaoffice.com. Now, on to the show.
You are listening to the Invest Florida Real Estate Show, covering topics in lending, buy and sell strategies, property management, hot markets, and tips and tools to guide you along the way on your path to real estate success. You want Florida investment real estate talk? You have come to the right place. And now, our hosts, Eric Odom and Steven Silverman.
Hello and welcome to another episode of the Invest Florida Real Estate Show. This is your co-host, Eric Odom. I'm flying solo just for a few minutes as Steven walked out to take care of business, but he'll be back with our guest in just a few moments. I wanted to read a message that we received from Tom from Sarasota. He sent us an email through our website at investfloridashow.com and said, "Love the shows, fellas. Keep it up. You guys have inspired me to do more deals and given me different ways to look at things. Now, would you also please do some more short shows? I don't always have an hour to listen to the episodes." I hear that, guys. Many people listen to us, and we know from our other listeners that most of the time you are listening to us when you go to work in the morning or coming home in the afternoon or traveling between work sites or whatever it is that you guys do for a living. And it's 15 to 20 minutes of drive time. And that's, usually the time that you're spending on the show. And we get that. So in response to Tom and some other requests from folks, we have started a new series inside of the short episodes. We already have Landlord Tales. Now we're also going to be doing what's called Lawfare. And Lawfare, we're going to be having various attorneys coming in and talking about deals that went south, why they went south, how they might have been prevented from a legal standpoint, how the investor might have been able, or the developer might have been able to protect their rear end. So we want these episodes to be less than 15 minutes. And so you can, get quick hits from us. And hopefully that's going to be something that is going to be useful for you guys. We'd love to hear your feedback. Also, please keep questions coming to us. Send us emails. Give us suggestions. We don't know what you don't know. It helps us tremendously for us to get feedback from you. And that way we know which way to take the show. So, please, Tom and other folks that have reached out to us, please keep those things coming. In this episode of Lawfare, we're going to be talking about Section 1031's single tenant properties, triple net properties. Okay. Those are the things we're going to be talking about. And we've got an attorney that's going to be joining us to talk about the various things you might want to consider. And we're also going to cover how a 1031 works from a 30,000 foot level and some things you might want to try to think about as you're contemplating whether to engage in a 1031 or not. Now, we focus on Starbucks. And we talk a lot about Starbucks. And I want everybody to know, I don't hate Starbucks as an investment. I have to qualify that in advance. There's a lot of good Starbucks investments out of there, but hopefully this is more of a metaphor for other single tenant, triple net properties. And it could just as easily be a Walgreens or McDonald's or a 7-Eleven or a Wawa. It just happens that we keep talking about Starbucks, but the episode of Starbucks the discussion of Starbucks isn't focused on Starbucks really. We don't really mean to say Starbucks is, carried across the board in all the examples. It's just an easy example for us. It could have just as easily be any one of the other single tenant net lease investments that I just mentioned. But guys, I hope these are episodes that you're going to enjoy, and we want them to be short, quick hitting, and hopefully get you in and out in 15 minutes. So let's go ahead and roll on to our show.
Today we have with us Rob Gidel. Rob is an attorney that represents a wide range of clients in a wide range of real estate transactions, with an emphasis on the acquisition, disposition, development financing, and leasing of commercial real estate. Rob's been on the show before, and by popular demand, he's back. Rob, welcome to the Invest Florida show.
Thank you. Good to see you guys again.
And, Rob, we going to have you on more. I mean, we had you on, it was probably a couple of years ago, wasn't it?
I know. I've got some gray hair since the last time I was on here. I know that.
And Stephen, I mean.
At least one, yeah.
Yeah. Well, since then, we've had feedback from some of our listeners that they like some of the shorter, quicker hitting episodes. And so Lawfare is what we're going to call it. And you're our first Lawfare guest. It talks about sort of what's going on, quick hitting stories of how landlords can do a little better job of protecting themselves on the legal front.
And Lawfare is a great name. It's law and it's really warfare. It's strategy and things that you can help win the game.
That's right. I think of myself as a general, let me tell you.
Well, you had brought up a point on 1031s. I know you love 1031s. You think that they're the greatest thing since sliced bread. And but there's some issues. People rush into making decisions based on – it's really a tax decision and not a financial decision. When you get into investing, you should be making investment decisions, right? I mean, that's the point. Mm-hmm. You're in it for a return, and people lose sight of that sometimes in 1031s. I'm being sarcastic, of course. I mean, you can,
of course, yes,
fill in the blanks.
Well, absolutely. There's parts of the 1031 that I think are advantageous to the investor, and there are things sometimes that get overlooked. Particularly when it comes to kind of dialing into the lease. I have to say, number one that I come across is actually generally, buyers of these 1031s, they're buying it directly from the developer. Well, his incentive and his focus when he's negotiating the lease is sort of a shorter time frame. They're not looking at the long term. So that's one issue that we see. And then we also see a lot of 1031 buyers that are buying based upon the renewal options. When there's a shorter time frame for the initial term, they look at the renewal options and already anticipate that the tenant's going to exercise, and that's not always the case.
Yeah, well, let's look at.
So they're looking for a credit tenant, and they figure like it's got a strong tenant, and he's just going to renew.
Yeah, and let's back up a little bit, because really, what you're talking about are triple net properties, right?
Correct.
And those are popular in 1031s because they're easy. The perception is they're easy. They're hands off. The tenant's responsible for the expenses. By and large, they tend to be triple net leases, which means that the tenant's responsible for paying the taxes, insurance, and maintenance on the property. And so if somebody's rolling out of an apartment complex that was managing 20 or 30 units, the idea of collecting a rent check from Starbucks or 7-Eleven or Wells Fargo Bank seems pretty attractive, particularly if you're not going to be receiving calls on tenants, toilets, and trash anymore, the three evils of real estate ownership. So that's one of the attractive parts. And then people are maybe a little bit blinded by the tax aspect, right?
Well, just to clarify for some people who maybe are listening for the first time, what a 1031 exchange is. A 1031 exchange is a like kind exchange where you can sell your property and avoid paying
You're not void, you're deferring.
Avoid for now, paying the capital gains tax and the depreciation recapture and put it into the new property. So sometimes people are focused so much on saving that money that they're not paying enough attention to the investment, which I think is the point you're bringing up, right?
Yep, absolutely. So now that we've kind of painted the picture, you have some wild-eyed decision-making going on the triple net side, that they're so captivated by the tax-deferred nature of the 1031, and they no longer have to deal with very high-maintenance residential tenants. I'm using this as an example. It could be any kind of transfer. But they're now acquiring a 7-Eleven or a Starbucks, and they might not ever call them, but once or twice a year. So what are some of the issues that, or you point out one issue then in terms of the lease, that people get so excited about the 1031 and the tenant that they sort of overlook, and they're under this pressure to make a deal?
Right. So like I was saying before, and just as a quick caveat, I'm speaking as a lawyer licensed in Florida, general terms here, every situation.
Oh, well, here comes the disclaimer. Go ahead. We'll let you do your disclaimer.
Always seek the advice of a licensed attorney on these issues, because they can deviate. But essentially, what I was saying, when you're looking at who you're buying it from. So if it's a developer, for instance, there's usually going to be some maintenance obligations with respect to the improvements that were initially constructed. So that may fall on the new quote unquote landlord. So the 1031 buyer that comes in, they may be obligated under the lease for latent defects or patent defects with respect to the improvements for a period of 1 year. So those warranties are very important that you, if you're buying if you're a 1031 buyer, it's important to make sure that those warranties run and that the existing landlord, the seller here, is going to be remain on the hook for any of those defects or the construction. I would also say that, with regard to the actual tenant, you mentioned Starbucks. Finding a triple net tenant these days is somewhat difficult because I think they've gotten used to the game at this point. And so the finding triple net opportunities is very difficult because a lot of these quote unquote triple net leases, or at least the way that they have been framed to you, may still have ongoing maintenance obligations with respect to the structure. And so that means that it's a lot different than what you may be accustomed to in the past. For instance, with a 7-Eleven, which used to be such a great investment, people saw the mailbox cash. There was no really correspondence. To your point, it was very easy. They were getting their checks. These tenants, such as Starbucks, have gotten used to this and have adjusted their thinking. And now it's more of a double net. So there are maintenance responsibilities now with these Starbucks leases. And Starbucks is no different than others that are requiring that their landlord is going to have some role in their relationship on an ongoing basis. And I think it's difficult when you're a 1031 buyer to understand sometimes what are the downsides, because as we've seen in this retail environment, there are some downsides to situations when you're so invested in the actual tenant and its operations, because you can get in situations where finding someone to step into the shoes and buy that lease after the fact, after they've left, it's very difficult. And I've seen several circumstances with gas tenants where there is a stigma associated with existing gas stations that new gas stations aren't as inclined to go, jump in and quote unquote inherit somebody else's problems. So you just have to understand those risks when you're a buyer, that it's not nearly as gravy as it seems when you first buy it. And,
you have to be somewhat careful too. I mean, we'll talk a little bit about the lease aspect. Many triple net, not all of them, but many triple net owners, they're selling. I mean, if life is this luxury lane for them, why would they be motivated to sell? And frequently what we see when properties are coming on the market on the triple net side is that they might have a 10-year lease and they're 6 or 7 years into that lease. What happens, Rob? What have you seen happen with some of these leases? Now, I've known people that physically go out and walk the property and during busy times and non-busy times and try to make sure that there's going to be a renewal there, but there's no guarantee.
There's no guarantee.
And the tenants often won't tell you. They're pretty close-lipped about it.
Correct. Because it's all leverage game. I would say that usually in these leases, the renewal options are in essence kind of maybe a starting point on a negotiation. I've certainly seen most recently with specific gas tenants here in the state of Florida where the renewal option was, let's say it was $14,000 a month for rent. And the starting point on the negotiation for them to exercise their renewal option was somewhere between $4,000 and $5,000 a month. So they're cutting the rent more than half. And you have no ability, particularly if the tenant is a private company, to really understand how they're doing financially. And they don't really need a justification. And sometimes you don't necessarily, even if the company is doing well, they may want to get out of of Florida, for instance, at this point, because they've seen the competition in the marketplace. You have no control over that. So it's very much kind of out of your hands.
Or they may be sophisticated game players now, and they recognize when the time comes for renewal, they renegotiate no matter how attractive.
And I think that's a key point, because the tenant understands that, listen, they're professionals in the real estate business. Retail is retail. They manage their business and whatnot, but they are as much in the retail game as any other institutional player in the market. And they understand that they have a large degree of leverage, particularly if that property's sold. You might, for example, to mention Starbucks, the market rent, because I can speak from this with personal experience, market rent might be $9 or $10 triple net in that area. And Starbucks, because of the upgrades they've done, are at $58, $60 triple net. And Starbucks understands that. So the propensity or the possibility that they're going to do what's referred to as a cram down, it doesn't matter what's in the option, right? People say, oh, well, the option's that I'm going to renew at 65, and they start counting those chickens before they've hatched. I don't think I've ever seen Starbucks come in and execute at their option without at least firing a salvo over at the landlord. I mean, what are you seeing, Rob?
Right. I see that kind of stuff happen all the time. And, to be honest, if, looking at it on the flip side, you can certainly understand why they would do it that way. I think it's, just kind of passing around, before the show here, just talking about all the different issues that we've seen. You can kind of understand why the tenant has a little bit of leverage, and they're going to take advantage of that. And they're certainly not just, going to just exercise without at least having a conversation, at least from what we've seen. So I think you need to take all those factors into account when you are buying. The location needs to be the number one factor in what your focus is, because you can't change the location of the real estate. If the real estate's in a prime location, you'll have a better ability to find somebody else, and you're able to negotiate a little bit better from a different leverage point than otherwise. And I think that's more important than what the rental rate is that you're getting by the time you're jumping into a lease.
Yeah, I don't think there's any question. And I think another point, again, I'm picking on Starbucks here, but you've got a situation where they're typically written in the lease that even if they decide to move out, let's say they move out before, and this happens, people say, well, Starbucks not going to move out. Of course they do. They'll move out before they've taken possession of the property even. They'll move whenever. And that creates a whole nother set of problems, because they might still be paying you rent, but they're trying to do what's called a cram down then too, reduction of rent. And they hold you hostage because you can't necessarily lease to anybody else without running it through them. And if they've got leverage on you, they're not letting you lease to anybody else. They want to inflict some pain on you. So these are the things in a lease. And, you hear people say, well, I'll use my own lease. Well, how many times have you seen Starbucks use somebody else's lease?
I've never seen it.
Yeah, okay.
I'm sure they got things in there that are tailored specifically to them. And, the truth is they're out there doing this 1,000 times a year. And, a landlord's maybe doing this. If he's a big landlord, he's doing it 10 times a year. And
the little guy might be his only one that he's done. Yeah. And is Starbucks going to – I keep picking on Starbucks. I don't want them to – Starbucks, don't sue me, please. But
go get some coffee here. Yeah. We'll come back.
They're not going to pick on a REIT that has 300 of their properties. The REIT has a legal staff, paid legal staff. That's not going to be someone they're going to pick on. What they're going to do is they're going to go after the individual owner that doesn't have the back office support to successfully negotiate with them. And these are the ones they'll try to target. Do you find that to be the truth also, Rob?
Right, absolutely. And I think Starbucks is a fabulous tenant for the most part. So I don't want to pick on them, but absolutely, I see situations, and you're absolutely right. I mean, most are more inclined to, when assessing a situation, are we going to make a move one way or the other? They're going to pick on the one that's going to have the least consequences. In that case, generally speaking, it is the family trust. It is the mom and pop that is the the ground lessor or the landowner that is the one that gets approached about, a more than 50% rent reduction if they're going to stay. But there are other issues associated with, the repurposing of space when you're in a 1031. Sometimes sites can be restricted under the REA or ECR, and those are restricted easement agreements that encumber the property or that are recorded on the property, and that prevents sometimes the ground landlord from being able to find an alternative tenant that kind of matches the existing tenant's use. And that's because the restriction that's on the property may have had a very specific waiver for a certain tenant. And so that specific waiver is tied to that specific tenant, and therefore the use is still restricted. So you might be stuck in a situation where you can't find anybody to take it over.
So just to understand that a little bit more clearly, and go back to our example of Starbucks. So maybe Starbucks was given a waiver and they were allowed to operate, but the underlying agreement said that no coffee shop can operate there. Starbucks had a waiver. If they leave, then no, you can't go to Dunkin' Donuts or anybody else to bring them in.
Correct. That would be an example of that, where you're stuck with the restriction that's on the property. And so you would have to find a use that was compliant with the outside the scope of those restrictions.
Well, I think really the bottom line is that don't be blinded by the tax implications, because as we started this podcast, we talked about you're getting into investing for making money on the investment. Don't be blinded by the tax advantages that you have in a 1031. Just be smart about it. And this goes into the legal aspect as well, too, from the contract, the lease, that you're carefully screening that and weighing that. You're on this time frame of buying and identifying when you're in a 1031. And
it's pressure.
It's pressure. But don't overlook these legal issues, because there are a number of potholes, both in the contract and in the long-term viability of the investment. Is that fair, Rob?
Absolutely.
So is there anything else you'd like to add before we let you go?
Well, I think specifically with respect to just if you're going to buy it from a developer, as I mentioned before, they just have a different priority. And that's not to say I represent developers. I love developers, but you have to understand where they're coming from. And when they're negotiating a lease, we always are acting in the best interest of our client. And we're trying to think about long-term issues. But if you've got a client who's anticipating only having it for a short time, there's going to be some issues that are more long-term that they're going to probably overlook because it's not necessarily their most highest priority.
Great.
And it's in their interest to really think long-term so
Absolutely.
that they can sell it.
Absolutely.
Rob, we're going to have you back again. We're going to do more of these. We like these quick-hitting episodes, just giving people things to think about as they carry on with their investing journey. But thanks so much again.
No problem.
You've just listened to the Invest Florida podcast with Eric Odom and Steven Silverman. Join us every week for actionable real estate investment ideas, and of course, visit our website at www.investfloridashow.com for more shows and tips on how to earn a cash flow in the real estate market in Florida. While hosts and producers of the Invest Florida show have no reason to doubt the validity of comments of our guests, we do not warranty their accuracy. Please check with your legal, financial, and tax advisors before entering into any investment. Returns will vary from person to person and deal to deal based on unique circumstances. All information expressed in this show is for educational purposes only. Opinions of the guests are not necessarily shared by the hosts and producers of the Invest Florida show.